Hello, everybody. So I have a large position in many of the stocks I cover, but they're not necessarily at buy prices today. You can always increase your cost basis, but part of my channel is trying to find the best opportunities right now and to enter stocks when they are actually relatively cheap or inexpensive. It's a big focus on this channel, so it's tough for me to really justify increasing my positions by a large amount in something like a MicroStrategy, a Tesla, or HIMS, given the current weight in my portfolio. However, there's 4 stocks that I find particularly cheap right now and that I fully intend to add to my portfolio in February and the end of January. So let's begin. The first stock I want to cover is Marathon Holdings. So this is a Bitcoin miner. This is the largest Bitcoin miner. The CEO is Fred Thiel. Fred Thiel is well connected to the Trump administration, connected to CELH. What's very interesting about Mara is, going back to the slant of this channel towards being a value investing, where we cover a lot of value investing, value growth and value, high growth and value together is a style of investing that I do. And so when I look at Mara, it simply looks to me like one of the cheapest miners out there. Why is that? Well, if you look at the margin of safety, they have almost 70%, 69.63% of the market capitalization of Mara is Bitcoin. So they're a huge Bitcoin hodler. They hodl more Bitcoin than MicroStrategy. 70% of the market cap is Bitcoin. And of course, what do? They mine this Bitcoin and they hodl it like every single other miner does. Most miners do that. Iron doesn't do that, but most of them do. But more importantly, they have implemented the same MicroStrategy strategy of issuing convertible debt to buy Bitcoin, and they've implemented it in a big way. Out of all of the miners, they're those who have implemented it the most, and I think the market is sleeping on this one. It's only trading at a price to NAV of 1.44. You can see MicroStrategy is 1.8, but of course, unlike MicroStrategy, they also mine Bitcoin through their operations, and of course, they're one of the older Bitcoin miners. But it actually makes sense for them. If they have a strategy that fits their mining rigs, their strategy is to try to locate the miners where energy is near zero or 1 cent a kilowatt hour. And so they have containerized compute. They call it dispatch compute. And so they're able to move the miners around towards stranded energy, stranded natural gas, stranded biogas. And they move these containers and they're able to mine at a very low cost of electricity. And, there's really 2 strategies in miners. You either have the most efficient Bitcoin miners and you pay 4 cents, 5 cents a kilowatt hour, but you have the most efficient miner, or you have miners that are 3 years old, but you pay 1 cent. And their strategy is older miners, but of course trying to pay as little as you can as electricity. I think the market heavily discounts this miner, and the margin of safety of being 70% into Bitcoin, 70% of the market cap into Bitcoin is compelling to me. That's why this is a stock that I already own and that I plan to add to. Stock number 2, another stock that I already own that I plan to add to, is LifeMD. LFMD stock. I call it a baby HIMS. Unlike HIMS, who really focuses on one condition, one provider. So you'll have, for example, an ED condition, and you'll be seeing someone who's specialized in ED or a urologist to get your prescription for ED. That's kind of how HIMS does it. This one has a bigger focus on primary care and more chronic issues. So they'll have internal medicine doctor, family doctors on there. They actually hire MDs. They're located in New York City, and they hire something like more than 50 MDs who are just there providing virtual consultation. 1.1 million virtual consultations they provided since their existence. 269,000 active patients. And just like HIMS, they have a membership, but the membership is a membership to the doctor. quite simply. And so for $39 a month, that's their 117 every 3 months. That's their popular plan here. For $39 a month, you get one doctor visit a month, and that's obviously the service they're trying to push. They also have one-time visit for $104, and then you see the doctor, and of course the doctor decide whether you should be prescribed or not. So really, it's all about primary care. The big advantage of focusing on primary care is that you can address issues that are a little more complicated than what HIMSS addresses. And so this is what they're going after, $170 billion total addressable market in the US. They are, along with HIMSS and some other companies in the sector, simply disrupting the family doctor by becoming a fully digital app doctor, and people, of course, pay out of pocket. For $39 a month, that's just out of pocket. It's just slightly more expensive than a Netflix subscription, but they have a monthly doctor visit. Just like HIMSS, they don't accept insurance. Because of that, it allows you to have transparent pricing, clear pricing. You see right away the cost, which a lot of customers really love, and the convenience of not having to drive to the doctor's office. I was reading this survey that came out that says that something like nearly 70% of Gen Z and millennials would change medical providers if they had to go do doctor visits, right? So this change of society is not happening just in the workplace. It's also happening in healthcare. Gross margin is similar to HIMSS. The business has been growing very fast, actually just about roughly in line with HIMSS, maybe slightly slower than HIMSS. They are achieving EBITDA profitability this year. So when they announce Q4, we should see them have achieved EBITDA profitability, which means that I anticipate the market will start to notice them, especially if maybe 6 months, 9 months from now, they start posting GAAP profitability. This is when I anticipate the market will start noticing them. The reason for the discount, if you look, so it's cheaper than HIMSS, right? HIMSS on enterprise value over gross profit over revenue growth, which is my metric on this channel, HIMSS is a 0.11, which is very cheap. But LifeMD is a 0.042. That's because they have a legacy business, unrelated business. It's a scheduling software called WorkSimpli that they've been trying to unload. They've been trying to sell it. You can see it in the dark blue here. That's the WorkSimpli. It's a SaaS business. It's a flat business, and they own it due to their legacy operations. And so they're trying to sell it. And once they sell it, they will be seen by the market as a pure play telehealth business. But right now, of course, since they still have it, it looks like the business is only growing at 29% year-over-year revenue growth. And by the way, the number for gross margin and EBITDA margin are similar between both businesses. If you remove WorkSimpli for the business, and if you assume they sell it at fair market value, then you have a business that would be growing at 53% year-over-year, and whose valuation would be much cheaper. So I'm assuming they sell that business for $50-ish million, and then you would get an enterprise value over gross profit over revenue growth of a 0.02. So really dirt cheap. Top 3 cheapest stock that I have in my spreadsheet of over 200 stock. Rule of 40 is achieved regardless of whether they keep WorkSimpli or not. So I love LifeMD. I'm looking to increase my position in February. Moving on to a third stock where I already have a heavy position. Well, it's not that heavy, but it's beginning to weigh some more in the portfolio. It's Celsius. Celsius is a former stock market darling. The stock traded near 100 back in early 2024. I still see Celsius being a consumer darling. It's a consumer favorite. I see it everywhere. Every convenience store across America still has it, and the product still sells out based on my anecdotal evidence. But of course, the stock dropped quite close to 75% drop. Why did it drop? Because of a sell-through issue with Pepsi. Their distributor in the US is Pepsi, and they over-ordered, and they're sitting still on millions of cases, and so they're currently right-sizing their inventory. They're currently ordering less from Celsius because Pepsi is having to go through its cases now, because Celsius is a business that's very much driven by Instagram, social media, flavors, etc. Pepsi, it may have some issue selling some of the flavors that may be less popular. That would be my guess. It's a short-term issue in my view. At one point, the Pepsi inventory will be right-sized, and Pepsi will start reordering in line with what we see on Amazon, what we see at Costco. The business also is starting to go internationally. I've seen it in Europe, and it seems to be selling through there. At least we'll see it in the numbers, but what I saw anecdotally is that it was selling through in France. At least I saw some people buying it. The stock dropped even more recently, actually, because of an analyst was saying, Alani Nu is taking a lot of the business. Well, if you're in the US, you probably see Alani Nu. Alani Nu is a super niche product. I would argue I only see Gen Z women who are drinking Alani Nu. That's who I see doing that. Celsius, I see everybody drinking it. Celsius is a mass market product. It's a standout in the category in my view. It's 200 milligrams of caffeine that we're selling in a can. It's vitamins in a can, as I called it in a prior video on this. And of course, when you sell a product that has 200 milligrams of caffeine, it's kind of like you're selling alcohol, you're selling a fatty food. Customers keep coming back. That's why the proper frame of reference here for a stock like Celsius, in my view, is the food and beverage stocks, and it is the cheapest food and beverage stock out of all of them that I analyze. You can see you have hip brands like Dutch Brothers and Cava and Shake Shack, even compared to Starbucks or Sweet Greens. It's cheap. It's very cheap. It's 0.22. It's the cheapest. It achieves a rule of 40 out of 56. I'm assuming revenue growth next 12 months will be 34%. You may think it's a little high. You know what? Even if you say it's only gonna be 15%, you're still the cheapest stock in the categories. That's why I'm very happy to own it, and I am confident about the future of this stock. No financial advice ever, of course, on this channel. The last stock that I like very much is TGTX. I've been trying to buy this stock. I've been selling cash secured puts on this stock with the really nice hope of being assigned, and I haven't had the chance to be assigned, so I'm going to have to do a straight equity buy on this one because I really want to own this one. This one is TGTX, TG Therapeutics. It's Briumvi. It's a monoclonal antibody, kind of taking part in that whole revolution of medicine with B-cell and with these new treatments that really we've seen over the past 5 years. These treatments are sort of mini miracles in my view. Of course, I'm not a medical practitioner, but they do seem to be mini miracles, and they are having a lot of success with these products. So Briumvi is a treatment for relapsing multiple sclerosis, called MS, often in the market. It's a neurological disease where your nerves are getting exposed. The insulation of your nerve is getting exposed. Very painful disease. The patients really want to get it treated. And the FDA, per the CEO, the FDA has approved Briumvi is the last B-cell therapy approved for RMS. And according to the CEO, latest conference call from the CEO, he's fairly confident there will only be 3 B-cell therapies approved. The FDA is happy with 3, so they will let 3 companies exploit this market until the 2040s. And Briumvi is the late entrant, and so the last entrant in this category. They've priced the product to be the cheapest B-cell therapy for RMS and also the quickest therapy. It's a 1 hour, twice a year after an initial dose, while the competition is 3 to 4 hours. And so the treatment centers love that it's 1 hour, and of course the patients also love that it's 1 hour. The last thing you want to do if you have any chronic disease is spend an entire afternoon or an entire day at a treatment center multiple times a year. That's the last thing they want to do. They're advertising to patients, they're advertising to providers. Of course, it's the new product on the scene, and doctors being doctors, their legacy, they're not necessarily exposed to the new products. They're used to prescribing something. They keep prescribing it until they are shown a better product. And so this is TGTX. The story of TGTX is now one of a sales team and now one of advertising, where you're trying to sell Briumvi, the next generation, the latest anti-CD20 for MS. And so the revenue growth has been outstanding, plus 160% compared to Q4 of 2023 versus Q4 of 2024. which they are just commenting on right now, right? And it's going to be an enormous market based on what I can see. So, like I said, it's patented until 2042, and so I anticipate late 2030s. You might see a generic for the competitors of BRIUMVI, but they are protected on their treatment until 2042. Think about that in this world. That's just crazy in this world that you could be legally protected for so long. This company, in my view, is going to make a lot of money. That's just my view, no financial advice. The market is predicted to grow, unfortunately, but predicted to grow to 12 billion by 2030. So this is a disease that is still, unfortunately, MS is very prevalent. And what if we're just number 3? Let's assume the market gets split among BRIUMVI and the 2 other players, 33% of 12 billion. That would be 4 billion in sales by 2030. On a product with an 88% gross margin, on a product whose EBITDA margin, if you reduce the sales team by then because you're well entrenched, you could have an EBITDA margin of 40%, maybe even higher. So in my view, this stock is very cheap right now because an enterprise value over gross profit or over revenue growth, you're paying a 0.19. The rule of 40 is through the roof because I am anticipating that this company will double their sales again across the next 12 months. And this is, again, very needed treatment, a very needed product. If you have MS, typically you want to get treated because it's a very painful disease. And so I'm very happy with this one. I want to own it. I hope my cash sticker puts. I hope I'll be assigned at some point. If not, I'll just have to do a straight equity buy on this one. Main risk on this one, I'll conclude with that, and this is true of many small single drug company. The main risk is they get acquired by a bigger fish, by a bigger company. That's the main risk, and I would be disappointed about that. That's one of the risks, because they're still an inexpensive company at 4.7 billion in enterprise value. So anyways, this was not financial advice, not investment advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X, follow me on Patreon if you want to get access to all of the spreadsheet and all of my posts. I'll be more active as of next week on Patreon. Thank you so much for watching this video and have a wonderful, wonderful day.